Hey, Amy Novakovich here. Thanks for listening to Nova Wealth Show. I'm here with my wonderful, handsome husband. I'm liking the outfit you got going on here today.
And these buttons are like holding on for dear life. I feel like this is awfully tight.
It looks good.
Well, I hurt my back this week, so I haven't worked out all week.
So you feel bigger.
And the buttons agree that I think it's bigger. That the body's bigger. That it's
my
holding.
husband Jim.
Hi.
Hi. So we make a lot of decisions. We help clients with investing, right? But some of the biggest impact that we can probably make is just by the way you overall invest. So big picture, there's just some little tweaks. Some. We're gonna go over 3 today. 3 main things that you can do in your retirement planning that will make all the difference in what your wealth ends up being.
What we have is number 1.
The first one is having the wrong. I know we always talk about your goals, right? Like, what are your goals? But sometimes you have the wrong goals, if that makes sense. Like, so this comes from an example. I met with a client. You're so confused.
Right? I am, because I'm not. I didn't think we were talking about goals.
No, it is. No.
Did everybody see me? I kind of looked down like,
you can follow.
What the hell is she talking about?
You can follow what I'm saying when I finish. So that's how I finish. You'll follow what I'm saying. So when you are a long-term investor, right? So I met with a client, and she's 25 years old. Mm-hmm. Okay, her retirement is probably at least 40 years away.
Yeah.
Even if she's lucky, 30 years. And she's invested in, it was at least half very safe, fixed between money markets and bonds. So her goal for her retirement account, which should be long-term growth because she's got 30, 40 years, was wrong.
Right. Yeah,
you know,
because with retirement accounts, you can't touch that pre-tax investment.
So you're 59 and a half.
59 and a half. So you said she was how old? 25?
25. Right?
Yeah.
So you see what I'm saying now? Now that we can go back on what I just was stating before and you said you wouldn't understand. But it makes sense now, right? Like sometimes your goal is the wrong goal. So you have to have advisors that kind of lead you in the right direction too. Like of course, your opinions and your goals matter a lot. And she was coming from the place of I don't want a lot of risk. You know, she was coming from the place of I don't want to lose my money. But what she didn't understand is every investment, this is 401k, every investment was hundreds of positions, you know? So she had maybe 5 or 6 different funds that have maybe at least 100 positions in each fund. So she'd need hundreds of companies to go under in a day for her money to just blow up. So she didn't realize that.
Right.
So she just needed a little education, which is why we're educating you now, because this is something that over the last 2 years, the market's done well and she's missed out because she just had the wrong guidance.
Well, I think it's tough for people when you look at the market and you see that it's been up for, well, really since 2009, the market's been on an uptrend.
Right.
And every day people are saying, oh, we made a new high, so should I get out? And the answer is always, I don't know, is the market going to go down tomorrow? I mean, nobody knows.
Right.
So she's probably thinking, I'm guessing that she was thinking that
No,
the market's
been that way though. I
Yeah.
asked her that question. I know where you're going. Like, did she just switch that? She's had that.
So, so speaking about goals, if their goal is retirement, and for a 25-year-old to have a goal of 59 and a half to retire, who cares where the market goes this month, next month, even next year? It doesn't matter.
It's not going to matter.
Because
in 5 years,
eventually
in 10
it'll
years.
be higher. Yeah, 30 years she's going to retire.
Right. Like I could even draw a little picture here. Like, this is what the goal is, right? So, of course.
You're going to draw the picture and put it up to the camera?
I guess. Like this. Can you all see that?
That looks like it's going this way.
Oh, because it's opposite?
I
this way?
think that didn't help. Put the paper down. Put the paper down.
My point is, you're going to have these ups and downs, but you're going to get from point A to point B, which is over time, right?
Yeah, I think that is left to right. It just looks backwards on our camera.
Next time we'll
Yeah,
know
but
right
over
word.
time the market goes up, so it doesn't matter where the market
little
is
dips don't
in the
matter.
short term. Unless the goal is, like if the goal was for her to buy a house in 2 years.
Different.
much
Completely
different because the time frame is shorter. But when the time frame's longer, you could be in equities as long as they're the correct equities.
Equities are stocks, by the way.
They're in stock.
Stocks and equities are interchangeable. So yeah, so that's the first mistake, right? So we're talking about the 3 biggest mistakes. I don't know if they're the biggest. They're definitely the most common.
Maybe even not
3
the most
very
common. It's the
mistakes
3 that we thought about.
That are the easiest to fix. I'll say that. They're very easy to fix.
Easy to fix.
I mean, that's literally a couple clicks of a button, right? So you just, and the other example that I'll give you on the whole goals. So the first one was that sometimes your goals are out of whack, and that can hurt you. So I've also seen, I had another person that came into me with a Roth IRA. So a Roth grows tax-free. And when you retire and you pull that money out later in life, that's tax-free money. So you got to try to grow it as much as possible because you don't owe taxes on all the gains. It's the one type of account. A Roth is a type of a retirement account that is taxed differently from regular investment accounts. So as time goes on, the more beneficial that account is to you, the more money you make because you avoid taxes. So she had all of it sitting in cash. All of it in cash.
One of your clients, huh?
Yeah. I changed that.
I would hope so.
So that's what we're talking about. So the first mistake is, of course you're going to an investment advisor or a financial advisor for actual investment advice. But you have to consult on your goals too. Like, am I on track for what I want, which is X, Y, and Z? You know, you have to consult with the experts on, is this what I want? Explain to me your ideal situation for this money, and I'll help you get there. Okay.
All right, what's number 2?
So
I can't read your writing to save my life. I really can't. I don't know where we're going.
Well, it's also in red ink, which doesn't help. So we're talking about the
I could read red ink.
3 mistakes that you make in retirement planning. And the first one is your actual goal and how you go about investing the money can be wrong, which can throw your whole wealth plan off track. The second one is putting your money in the wrong type of retirement account. So we've talked about this a couple of times. I don't know if we've done it on a podcast, but definitely on like a Finance Friday on Facebook. But there's 2 different types of IRAs. There's the Roth IRA, which I actually just mentioned. You don't get a tax deduction for putting money in right now. It's a type of retirement account that you invest your money and it grows tax-free. Versus a regular retirement account, a traditional IRA, where you put money in and you actually get a tax deduction for that contribution, for the money that you just put in. But then later in life, the money comes out when you retire and it's taxable. So what we see a lot is people put all their money, every penny that they save, into these traditional IRA accounts that they get the tax deduction now, and later in their life when they go to retire, they owe taxes on everything. Every source that you have to pull from to live on in retirement is taxable, right?
That's the whole generation before us. My parents, your parents.
Yeah.
They just saved. They either had a pension or they saved in their 401k.
So then they started doing the Roth conversions that I'm sure a lot of people contemplated. So if you are not familiar with the Roth conversion, what it is when you move your money from your traditional IRA or your 401k accounts and you move it into a Roth. And when you do that, that causes you to pay tax on whatever money you move. So not the whole account, just whatever you move. If you have a $100,000 account and you move $10,000, you pay the taxes on $10,000. But then what that does for you is, now that it's in the Roth, whatever money you make on that $10,000 grows tax-free. And you can pull it out whenever you want. You're not required to start pulling out money, nor do you pay tax on money that you pull out. So what we try to do is a little bit of every type of account. So you have options when you retire of where you want to pull your money.
As far as tax efficiency.
So
it's not all in the pre-tax bucket.
The pre-tax meaning the traditional IRA bucket.
Or 401k, 403b if you work for hospitals, the pension bucket.
457.
Anything that's pre-tax
Right.
that's going to get beat up in taxes when you're 59 and a half and you start pulling it out.
Right. Anything that you get a tax deduction for contributing. So if you did a defined benefit plan, all those types of retirement plans. And annuities. is another one that you put your money in. You actually don't get a tax deduction for that at all. But when you pull money out of an annuity later in life, it's taxable. If you took, there's different options in an annuity, and we'll do a totally separate show on annuities alone. But let's just say for general purposes, okay, you are taxed on, if not all of the money that comes out of the annuity, at least some of it that comes out of the annuity is taxable. So when you're doing tax planning, you have to have different sources, different types of accounts in order for you to not get slammed with taxes when you're in retirement. So we're talking about if you have a lower income tax bracket. Why are you grinning? Are you grinning?
No, this is my face. I'm not grinning.
You're just happy. You're just happy to be here. So if you invest purely in the pre-tax account and you go to pull money out later in life and you pull out, let's say, 50 grand, okay, and you make a little bit of income or you have Social Security, that 50,000 can throw all your money into a higher tax bracket. Whereas if you have options, or even better example, let's say you sold a home that year, an investment property or something, and you've got a lot of gains that year. You don't want to go pulling $50,000 out of a retirement account. If that's your only option, then that's your only option. But you want to have different options so you don't pay all this extra money to the IRS. You're talking tens of thousands of dollars, really. If you had options of where to pull that 50 grand to live on in a year that you're going to have a higher tax bracket, you save yourself tens of thousands of dollars in taxes.
So the idea is you want to have the 401k area. Mm-hmm. You want to, and a lot of times the 401ks will give a match. So if you put in money, your company will match. So if they're giving you a match, you get free money, you want to save there.
And ask if your 401k, if your company in your 401k has a Roth option.
Yeah, that's a great suggestion. But you also want to maybe go right to the match, and then any extra money that you have to save, maybe start funding a Roth or a non-IRA account, investment account, and start saving there because they're all taxed differently.
Just a regular investment account, not a retirement investment account. This is all just titling. It's not types of investments, it's types of accounts. So if that makes sense to you, you can have a regular investment account, you can have a retirement investment account. It just means they're taxed different. You could put the exact same investments in. I wouldn't recommend that. Absolutely not. But you could, just to get the point across.
Okay, so let's get on to the third one.
Okay, we can move on.
Good. Moving on.
Can I summarize real quick?
I think you've done that. Go ahead.
Why don't you summarize? If I've done it, then you do it.
Summarize the tax liability. So the whole idea is you want to diversify your tax liability. So if the last generation, they put all their money in 401ks in the pre-tax area, which is great to save. It's a forced savings really, but once you get to retirement, it's all taxable. So you're not doing yourself a lot of favors in the long run. So if you're young enough and you have time, start saving into the Roth IRA, maybe even cash value life insurance, because that area of investing comes out tax free. Right. So you have the ordinary income that you're going to pay on the 401k area. You have no tax on the Roth and cash value life insurance. And then if there's still money, for the most part, and if there's still money that you have to save, let's open up a investment account and just have a regular investment account that's taxed at capital gains rate instead of ordinary income.
So you have options. Especially the life insurance comes in handy in down years in the market, and we can have a separate show on that as well. But you don't want that to be your only source either. So that's actually another mistake, even though it's not on our list. But another mistake that people make is they put all their money in life insurance. So there's rates that you pay on that money that you pull out of life insurance. So you got to be careful with that too. So you just want to have a little bit of everything is what we're trying to say.
And the reason you want to diversify that tax liability is you can either retire sooner or retire at the same time that you normally would, but just have more money to live on.
There you go.
Because you're going to pay less in taxes if you diversify your tax liability.
Great point. Great way to say it.
Moving on. Okay, to the next common mistake that people make with retirement planning, right? Trying to time the market. So when you say,
oh, the market is coming to a crash. There's been a couple bad days, and I just know it's getting bad. Pull everything out.
Or I saw on TV that the market is at all-time highs.
Or I read this article
this
that
guy
the
said,
market is going down 60%. I read all
my
this.
neighbor said.
Anyway, so it's this urge that people have emotionally to just do something like major.
It's called fear.
Fear's a big part of it. And so they take everything out, right? And then you're sitting in cash. Then when do you get back in? So you're trying to time the market. You're trying to do this buy low, sell high thing, but you're making giant decisions, giant irrational, emotional decisions that cost you money, quite frankly. If it's not in a retirement account, like what we just talked about, you pay taxes on every gain you have in the account, first of all. Second of all, you got to be right twice, you know, when to get out, when to get back in. And third of all, there's no actual plan there. You're just kind of reacting to things that go on in the news and in the media and in things that you hear in your neighbors, and that's not a good plan either.
Yeah, that's not to say you never want to get out of the market, because there are times that you should. If there's big events that are happening that the markets get very jittery on, you could certainly get out of the market and just get out of the way.
But define big event, because that's where you have this gray line where somebody says, like Brexit. Some people thought that was a huge event. Brexit is when England exited the Eurozone. So that was last year in June, and the market got hammered for like 3 days. And then it came right back.
It did.
Right?
And it really rallied after that, too.
It really did. So if you got out, you missed it. You missed that.
Well, we have a 3-day rule here that when
when
there's a big event like that, we let the dust settle. I mean, the market went down for those 3 days, and it could have went down for another 30 days or 90 days. It could have. And it didn't, but it could have.
Like our personal money, like I would almost never, it takes a lot for me to pull out all of my personal money, especially. Like I know the last time I was really freaked out was when Lehman Brothers failed. And we did pull people out of the market. So big events like that, when a AA rated institution goes under, you know, along with other institutions that are huge and giant, Wachovia, WAMU, Washington Mutual, you know, that's scary. That's scary. So definitely this isn't, he's right. We're not saying never get out of the market. That's not what we're saying. We're just saying every time the market has a couple down days, don't think you should just get out and then get back in. That's a recipe for disaster, because then you're missing opportunities and you're losing money and you're paying money on taxes, on gains. So it's no strategy. It's going to end up losing you money. So what you need to do is have an action plan specifically on different pieces of your money, maybe even specific positions. And we've talked about this in our Finance Friday of different things that you can do when the market does go down. You know, we talked about, and we definitely do not need to get into it today, but like trailing stop losses, having just a specific number in your head to try to take the emotion out of when a position goes down a certain percentage, like say 10%. When anything goes down 10%, I sell half. Or, you know, so be diligent about your plan, about your strategic plan.
I don't know about that plan.
Oh. Are we going to argue on this again? I was just trying to give an example.
That's an example. But
So say what's on your mind. So what would you say?
Well, just because a position goes down 10%.
Well, you could buy more. I guess I was just giving an example. That's my point.
I guess the point is have a plan.
Have a plan.
So,
don't just react to the market and sell everything, is what we're trying to say.
Because if a client is allocated properly, if the market's going to move. We've been very spoiled with the market going up. So as the market moves, as long as you're allocated correctly to your risk tolerance, it's fine. You know, because as long as everything doesn't correlate to the market in your portfolio, you have different asset classes.
Well, it shouldn't.
Right. Ideally, you're diversified well enough where you're not correlating exactly to the market.
And correlation?
Correlation is how your investments move relative to the stock market.
Yeah, how they relative to how they move to each other. So you want you don't want all your assets that when the market goes down, they all go down. And when the market goes up, they all go up. You want some things to hold you up in times the market is down and You know what you want.
Things like gold moves differently than stocks, and currencies
bonds moves differently, currencies, real estate, all these different asset classes. Anyway, so this is the third of 3 common mistakes that we're talking about when you're doing your retirement planning, okay? The first one was just having the wrong goal, you know, and I don't know that that's the right way to say it, having the wrong goal, but definitely your overall investment philosophy needs to be tweaked. We'll say that, you know. So if you have a long-term time horizon and you're invested in all cash, that doesn't match up. So you need to get on track with what you actually envision for that money. Your investments need to match that vision. So sometimes the investments don't match the goal. There you go. That's what it is. The second one is when you invest all your money in the same type of account. So you're investing all your money in IRAs or all your money in a non-IRA. So both are not good situations. You need to have a little bit in every type of account. So your taxes when you retire don't kill you. And lastly, stop trying to time the market, especially if you do have a long time horizon. We're not saying buy and hold. That is not what we're saying. Jim would be literally sitting here strangling me if I was recommending for you to buy and hold. That's not what we're saying. We're just saying your plan has to be a plan, right? It can't be just a reaction. You can't just react every time something happens in the news or every time you read something and that's your quote-unquote plan. You have to have something that's strategic according to your goals on what you're going to do with different positions in your account. And you will save money and you will be successful in building wealth. You won't just chip away at your wealth and lose money. Nobody wants to do that. So follow these 3 tweaks. We'll post this on Twitter. We'll post this on our Facebook. And what else? I think that's really it. Wow, that was quick. Maybe not so quick to you, but quick to us. All right. Thank you for joining. Have a great day.